Hi there everyone, this video is for Finance 6310, Advanced Venture Capital. Here is our agenda for this session. In Finance 6300, I talk about business being a dirty word. You're going into a career that has a stigma attached in the current climate. Business has a reputation for being uncaring, uninterested in the plights of the masses, and an excuse for unethical behavior. Business is an easy target for folks who aren't engaged in it. Business is even parodied as a synonym for evil. I love the satire of Lord Business in the Lego Movie, but there's a reason this stereotype is out there. I want to do two things. First, I want to encourage you to counter these stereotypes. And second, I want you to do that by celebrating what business does that makes our lives better and participate in business with the highest ethical standards. None of the negativity toward business is new. Back in the 1800s, Henry David Thoreau said, "It is truly enough said that a corporation has no conscience, but a corporation of conscientious men is a corporation with a conscience." As we launch into a discussion of what it takes to bring a company into existence and then to give it power by finding a way to finance it, it's important to keep in mind that these efforts have an impact on our world. I believe business, and startups in particular, can be an incredible force for good. I believe that business amplifies the intentions of those who work in them. I think that means that they can be transformative. I believe that business can solve so many problems and ultimately change the world for the better, like this simple solution to the difficult and often dangerous problem of transporting water in Africa, or this soccer ball that generates power from being kicked around all day so that children have light to read by at night. VC Tomas Tungas of Redpoint Ventures, who writes one of the best venture and startup blogs going, wrote about the transformational power of startups. When we think about just how many industries have been disrupted and improved in the past 20 years, it's kind of staggering to think how we got along without these things. And there are thousands of startups trying to make an impact improving our lives. This list is just those that made the unicorn list before 2016. Private companies with valuations over $1 billion have been dubbed unicorns. There are only 4 of these in Utah: Pluralsight, Qualtrics, Domo, and Inside Sales. The point is that if you want to make a difference in the world, there are few better ways than to start a company. Keep that in mind as we go throughout this course. Question: how many of you are interested in technology and tech companies? I know I am. So what is technology? We sometimes get confused and think that technology is circuits or lines of code. But the heart of technology is simple. Technology requires 2 things: an idea and execution. These 2 are like the sperm and the egg. The concept, or conception rather, of a company. Just like human conception emits a spark of zinc as the sperm meets the egg, a great business is conceived in a spark of inspiration, a solution to a problem, a better way of doing things. So ideas and execution, that's technology. PayPal founder and prominent venture capitalist Peter Thiel said in his book 0 to 1, "Humans are distinguished from other species by our ability to work miracles, and we call these miracles technology." Properly understood, any new and better way of doing things is technology. So what other technologies are there besides electronics? What about military technologies? What about metallurgy, agriculture, animal husbandry, politics, or economics? By Peter Thiel's definition, every company is a tech company. If it isn't different, better, or special, then why does it exist? What benefit does it provide? And what problem does it solve? Tech isn't new. Let's look at some historical examples. Here's a really old piece of tech, thought to have been developed 26,000 years before another piece of tech, the wheel. This is an atlatl.
And it's a spear thrower. Effectively, it's a stick with a notch in the end that lengthens the arm of the thrower. So the physics make spear throwing more powerful and accurate. Here's a shot of it from a Mayan petroglyph or hieroglyph.
Here's a military technology, a battle formation called the phalanx. The phalanx required each man to cover the next with his shield linked together like one giant sword, cutting through the charging mob. This picture is from the movie dramatizing the stand of the Spartan Greeks at Thermopylae, where they protected the birthplace of democracy.
The phalanx was strong for a long time. Then came the formation of the Roman legion. You might have seen this in some old movies too, this checkerboard pattern that allows the soldiers to effectively break up a phalanx and attack it in smaller chunks. Or how about this?
Here's a painting of the Mongols, who controlled the largest empire by land area of any empire ever to exist on Earth. What were their military achievements? Silk armor, so tightly woven that it allowed arrows to be removed without shredding the flesh. And they borrowed this little thing from the Chinese called stirrups. Stirrups allowed them to guide their horses with their knees and use both hands to shoot bows and arrows while mounted. Just like military technologies, we have advances in financial technologies too. This is Jean-Baptiste Colbert and Adam Smith. Smith would write a treatise on free markets and wealth creation that would get him dubbed the father of economics. Colbert was the father of an earlier system called mercantilism. One of the tenets of mercantilism was that there was a finite amount of wealth in the world, which of course meant that if you wanted to get more than you already had, your only option was to take it from somebody else. This idea spawned European colonialism. European kingdoms had been fighting with each other for centuries, and they were all pretty tough, so they decided to take wealth from easier prey, like Aboriginal natives in the less developed areas of the world. Adam Smith, on the other hand, showed that wealth could be created by increasing the number of transactions within an economy. We're going to talk a lot more about that this semester. His book, An Inquiry into the Nature and Causes of the Wealth of Nations, was published in 1776. Something else happened to be going on that year. Some upstarts in America decided to try their hand at creating a country whose economic system was based in the principles of free market economics, and they declared independence. Which brings us to the historical backdrop for equity financing. Back up a few years before the American Revolution, and another financial technology was developed. In 1602, the Dutch East India Company needed cash in order to make sure its ships carried full loads between Europe and trading partners in Asia. It was expensive to finance a whole ship full of cargo. They needed a lot of money. But most people individually only had a little bit of money. So they offered private citizens the ability to purchase small portions or shares of the cargo. In return, these investors would receive a proportional amount of the profit or return when the ship returned. This was effectively the world's very first IPO. And it wasn't without risk. The ships could sink, they could be attacked by pirates, or any of a number of hazards involved with sailing around the world in the 17th century. If we start with that first IPO, right, the Dutch East India Company in 1602, how has investing in public equity evolved since then? Well, the model continued to be refined in shipping and in tulips. There's a good exercise around the tulip crisis in the Netherlands. But by 1776, the nascent and financially creative United States actually sold war bonds to help finance the War of Independence. In 1792, 7 years before the U.S. Constitution was signed, 24 large merchants create the New York Stock Exchange by agreeing to meet each day and trade stocks and bonds on Wall Street in New York City. By the mid-1800s, the potential for raising capital in the stock market has become well known, and many companies are selling stock to raise expansion capital. By 1900, millions of dollars now are being traded. And this is still happening on street corners until in 1921, the stock market moves indoors. 8 years later, on October 24th, 1929, the market crashes hard. The crisis starts the chain reaction that will create the Great Depression. And then in 1932, FDR is elected. He'd run on a platform of fixes for the Depression. He begins enacting the regulations of the New Deal, including passage of the Securities Act of 1933. This is followed swiftly by the Securities and Exchange Act in 1934, which created the Securities and Exchange Commission. The SEC is still the active regulator of the sale of securities today. Now, ultimately, the point is that publicly trading a company's equity is the most advanced technology that we've developed so far for financing companies. As a result, there are stock exchanges all around the world. Here are the top 16, all with market caps over $1 trillion. Over 93% of the stock value in the world is in 3 continents: North America, Europe, and Asia. 87% of the value in the world is in the top 16 exchanges. And the New York Stock Exchange is bigger than the 50 smallest exchanges combined. Now you've got the historical context for how equity financing has evolved and how we got to where we are today. But if trading publicly is so great for companies, then that begs the question, why don't startups just go public right away? Well, the reason is that it's hard to go public and it's expensive. It's close to impossible for a brand new company. If you're super sophisticated, you can do it and you can set things up just right and use a vehicle like maybe a reverse merger into a public shell. But for all intents and purposes, this is out of reach for most founders, most startups. especially if you're doing this for the first time. So, what options do we have? Well, we can try funding the company ourselves. There are some options that don't require us to get outside help. Independent wealth is always great if you have it. Credit cards, sweat equity, which probably we'll be doing whether we like it or not. Personal loans, there might be something that we have that we can borrow against, some assets. We could apply for grants. We might be able to get people to gift us the money. That's always great. Early crowdfunding was essentially just getting fans to give you gifts for the promise that they might get your product in the future. For some businesses that works, but honestly most Kickstarter or Indiegogo campaigns end kind of like GoFundMe campaigns. They have a what can you do for me approach, and that what can you do for me model isn't very reliable. There's always startup competitions and profits. The best and cheapest money you can get. But that said, it's very difficult to do hypergrowth all on your own profits. Even if a very profitable company doesn't manage its cash cycle right, if it gets into a scenario where the cash cycle starts to demand more cash faster than it can collect it from customers, the company will go broke. So don't get me wrong, profits are awesome. You should always try to get them. So don't get me wrong, profits are awesome, but also they might not be an option for you up front. If we don't have the money, we can't win it or find it in enough quantity to achieve our goals, then we have to raise it. Well, how do we do that? Well, we're going to need to give something up. We're going to need to trade something for the money that we need today. What do we have to give up? We're going to have to give up some of the future. You've heard the expression that time is money? Well, the reverse is also true. Money is time. We're going to review options to trade on the time value of money. Let's review our options for trading future income for cash in hand today. There's debt. We could get a loan. With a loan, we give up future cash flows to pay interest. We also risk any assets pledged as collateral. This might be tough for us if we're very early stage, and we might not even have any assets. What about equity? Well, we can sell some of our stock. Now, we've already identified that selling in the public markets is probably not going to work for us. So that leaves those who buy stock in private companies. In other words, the private equity market. Private equity is broken into the following groups. Traditional private equity, typically looking to buy a controlling interest through a leveraged buyout of distressed or undervalued mature companies. Maybe not us. Venture capital, a slice of private equity that focuses on riskier new ventures from seed stage through growth equity with an eye to a future exit at a higher valuation. More about this later. Angel investors, high net worth, accredited individual investors making seed and venture investments by themselves, sometimes directly or through like angel networks, like there's the Park City Angels or even AngelList. And some of these through middlemen or brokers. Crowdfunding, right? This is a relatively newer category for individual investors to invest very small amounts of money for equity. So this course is going to focus primarily on scenarios where you're an entrepreneur selling equity to either angels or VCs. Our ability to grow a business, realize our dreams, and change the world depends on our being able to fund the business, which in this scenario means we need to sell some shares of stock. Most of the rest of the course is going to be around how do we tell how much the shares are worth, who do we find to buy them, how do we make that transaction work. But at this point, I'm going to take a little tangent to help you understand a few of the things, just the nature of the world of venture capital. The first thing is that venture capital occupies a tiny corner in the world of finance. Even though the numbers have drifted up a little bit since he said this in 2014, I think this quote from Mark Andreessen sums this up really nicely. He says, tech is really small. From a macro standpoint, tech is really tiny. So all of venture capital is 20 to 30 billion a year. That's up to about 70 billion now. But 2014, 20 to 30 billion a year. All private tech investing right now is 50 billion a year. And there's a lot of these bubble articles that talk about 50 billion a year, so how can you possibly put that much money into new companies? So against the S&P 500, just the top 500 companies in the country will give back 1 trillion in the next 12 months in the form of dividends and buybacks. And so total private tech investing is 1/20th of just dividends and buybacks out of the S&P 500. Is 1/20th too much? Is it too little? It doesn't feel like it's too much. Just again, to put that in context, the big mutual funds, like my friend Will at Fidelity, that does a lot of this, that's a $120 billion fund, right? It's like the total amount across all of tech investment is less than this in a year. And so it's just a very, very, very small amount of money. Here's a way of visualizing that. Venture is muy poco, right? But it's disproportionately influential. So take a look at this. Even though venture is this tiny little chunk of the overall piece of finance, 43% of public companies were venture-backed, 57% of the total market cap of public companies were venture-backed, 38% of the country's employees work for a company that got venture money, and 82% of the research and development in the country is done by companies that took a venture round at some point. It's also helpful to keep in mind that venture firms are often startups themselves. In San Francisco, you have some huge venerable firms like Sequoia and Kleiner Perkins, etc. But around the country, most firms are relatively small. Certainly that's the case for firms here in Utah. Most can count all their associates and employees on their two hands. That means these small firms have tremendous pressures to deliver returns, or they won't be able to raise a new fund, and as a company, the venture firm will fail. VCs can make money, but the huge money really goes to founders in the most successful deals. Jason Lemkin from Saster Fund says, a top founder takes much more risk, but can make a lot more than even the best VC of all time. A pretty good VC probably makes more than a pretty good and successful founder. Keep this in mind as you think about where you want to play in the startup ecosystem and where you want your future career to be. A few of these things already underscore that it's difficult and there's a tremendous pressure on VCs to generate returns. Well, if you're a bigger company raising larger funds, that can be its own kind of pressure. Andreessen Horowitz and Greylock Partners, for example, both raised over $1 billion in 2016. And this trend has continued. 2016, 2017 were huge years for VC funds to raise additional money. Now consider that in order to generate 20 to 25% returns in your fund, VCs need to average about 100% IRR on each deal that succeeds. That's because only 1 in every 3 or 4 deals are likely to survive. Now think about the challenge for one of the firms on the previous slide. You just borrowed $1 billion from your investors, and the only way you have to generate returns for them is to invest in startup companies. That is just no small challenge. That's why I call VC the X Games of investing. In the last video, I mentioned how we were going to approach understanding this category of finance using this model. Well, now we know the context of public financing and some of the challenges of VC financing, which makes raising money a very competitive thing. And one of the first things we have to figure out is, if we're selling our equity, if we're trading our future earnings, how much is our equity worth? With that in mind, let's open up our first can of worms and talk valuation. Valuation is at the heart of every question you need to know in startup financing. How can you decide how much stock to sell if you don't know what it's worth? How can you tell if the money you raise is enough to get you to your next milestone if you don't know the basis for how much money an investor will put in? At the highest level, any asset is valued in one of 3 approaches. The income, asset, or market approach. All 3 are attempts to answer the same question: what is the thing worth? And all 3 make the same assumptions. It's worth what someone is willing to pay. Real quick, the income approach is based on the present value of a stream of cash flows. This is really common for real estate, especially like income property. The asset approach is your book value, right? Assets minus liabilities. And finally, the market approach says, what has someone recently paid for a similar thing? If your startup is pre-revenue, income is going to be tough. There is no income stream to value. That said, SaaS companies are really trying to add recurring revenue to the tech startup model and strengthen the appeal on the income basis. The asset approach is likewise bad because, as we mentioned earlier, you probably don't have any assets. So how do you measure what the company is worth? As a result, almost all valuation methods for startups are some form of the market approach. In other words, we're going to use some comparables from the market to figure out what this company ought to be worth. We know that we're focused on a private sale of equity and not a public one, but would it really make any difference? Are private and public companies valued differently? Are my shares worth more or less if I'm public or private? So if we sold, say, 100 shares of stock on the public market versus 100 shares privately, which one do you think would bring a higher price? In other words, are private companies or public companies worth more? Let's run a quick scenario to compare. Here's a company generating $50,000 a year in sales and $10,000 a year in profit. Real quick, when we talk about sales or revenue, those terms are interchangeable. Sales equals revenue. Likewise, if we use the term profits or earnings, those terms are also interchangeable. They mean the same thing. So here we've got $50,000 in revenue and $10,000 in earnings. As an investor, you do not have to manage the company. It has a qualified management team in place. Your shares are privately held. There is no market for you to sell them. You're locked in until the company sells or does an IPO. We'll talk a little bit about secondary markets for private shares later, but for all intents and purposes, you are locked up. The company has to either do an acquisition or be acquired or do an IPO for you to get your returns. If you find yourself in a situation where you need cash, you are not going to be able to get it from this investment. You're locked in into this investment with no easy way to get liquid. Here's a second example. Exact same terms, but with a public company. Company B here is doing the same amount of business, has $50,000 in sales, $10,000 in profit, just like Company A. It also has a qualified management team. You don't have to run the company. The only difference is that it is public. You can sell your stock in this company whenever you want. So which company would you pay for? Well, the answer is Company B, of course. And why is the public company worth more if the companies are otherwise identical? Because investors are willing to pay a premium for liquidity. The flexibility of liquidity is worth a lot. The greater the liquidity, the lower the risk. That's why when you put your money into a savings account, it generates almost no return, because a savings account must provide zero risk and 100% liquidity. Let me mention something here. Startups have both risk and uncertainty. Risk is something that can be priced. You can insure against risk and calculate its probability. Uncertainty, however, is totally unknown. Private companies are earlier stage, riskier, and have less liquidity and a huge helping of uncertainty. That brings us to our final section. What drives the motivation to invest? If private companies are riskier, riddled with uncertainty, and offer less liquidity, why would an investor in their right mind ever take the risk? Well, let me tell you a secret. I could introduce you to somebody who would get you all to write a check right now, today. He's got a startup. It's the only one with the technology to make a new gene therapy for aging. It is guaranteed to extend human life by 40 years. It will soon be mandatory for everyone, just like fluoride in drinking water. You have the opportunity to be a part of a huge success, earn millions, benefit the world, and get in early. Are you in? I use this as an example to illustrate that investors invest because of the opportunity. Like any process where you want action from somebody else, whether it's sales or marketing or fundraising, this model from VC David Scott shows that all that's required is that the motivation exceed the friction and the concerns that keep people from taking action. So this is the same thing with investing. We need to provide motivation that overcomes any friction and concerns that investors might have to invest in our company. The irresistible opportunity is what provides the motivation for investors. So your first hurdle in getting investment is in articulating an irresistible opportunity. Your second hurdle is to give your investors a reason to believe that you can make the opportunity a reality. The reason to believe must overcome any friction or concerns. Most of what we talk about in this class will be about how to signal to investors that they can believe in your ability to do this, but none of that matters if you can't first show the opportunity. Your fundraising pitch assignment is about understanding how to make an interesting opportunity from your business idea. Which factors contribute to an investor's well-founded reason to believe that you can pull it off? Here's how Paul Graham, the founder of Y Combinator, the most well-known startup accelerator in the world, described that. He describes the formula for capturing investment as: make something worth investing in, understand why it's worth investing in, and explain that clearly to investors. In other words, show the opportunity and give them a reason to believe. Another simple but important thing to remember is that they are investors. Philanthropists, on the other hand, are donors. They expect nothing in return. Maybe their name on the building or to be remembered for their contribution. Investors, on the other hand, are expecting a return. They invest because they believe the value of their investment will go up. Sometimes founders miss this and think that their job is to woo investors and make them fall in love with their product. That's wrong. Investors may care about the product, but if they can't see a way to make money, they won't give you any. This class is structured to help you think like a venture capitalist. I want you to understand the world from the investor's perspective, so when you go out, no matter what role you have, whether you're an entrepreneur or an employee in a company that's taking on investment, or an analyst for Goldman Sachs that specializes in this asset class, you will understand both sides of this business. So putting our venture capitalist hats on, what's the venture capital model for seeing a return? It's this. We buy equity in companies at risk-adjusted private valuations, then sell that equity after an IPO at a public valuation. It's a buy low, sell high game. It also allows the investor to influence the success of the company. Most investors in venture capital don't take the company over, but they often take a seat on the board, they often help founders make connections to talent, to network, and ultimately to a future round of funding. And that does it for this video. I will catch you on the next one.